Good afternoon. My name is Mario Becker. I'm the founder and CEO of Das Family Office, a Singapore-based multi-family office. In the following video, I'm presenting Reflections, our quarterly update for clients, friends, and interested parties. I hope you're enjoying the video. Please share it generously with your network and people that you think could benefit from our thoughts. So welcome to our quarterly review. I can say that Q3 largely followed the previous quarters. That means the global economy is clearly on a recovery path, but we see some supply bottlenecks in logistics, and we also just most recently have seen spikes in energy prices. That has led to an overall increase in inflation, and naturally a discussion how the central banks are going to deal with this, and specifically the US Central Bank, if and when they will start tapering. Then obviously the discussion whether current inflation rates, which are materially higher than what we've seen in the last many decades, will prevail or whether they will go back to pre-COVID levels. But it's too early to tell this. These inflation discussions and the ongoing recovery in the global economy has led to an increase in interest rates. The 10-year US Treasury, which is more or less the benchmark rate for all global investors, has moved from less than 1% to currently about 1.5%. In March, we've even seen 1.75%. This naturally results in losses for investment-grade bonds, specifically also bonds with medium to long duration. Because we have this relationship that rising interest rates will lead to falling bond prices, whereas falling interest rates tend to lead to rising bond prices. This time around, we've lived through many years of falling interest rates, rising bond prices. Now we see the opposite, which is quite rare, but it happened in 2013 when we saw the so-called taper tantrum, and we're seeing it again this year. While investment-grade bonds and specifically long-dated government bonds have done really poorly, inflation-protected treasuries, so-called TIPS, have done quite well. They show positive results. And also global investment-grade corporate bond strategies. So not every bond investor is seeing losses. And we're seeing also good performance in global high-yield bonds. These are typically considered risky investments or risk assets that behave more like equities rather than safe bonds or investment-grade bonds. Also, Tier 1 capital and preferred securities have done really well so far this year. Asian high-yield bonds are a big exception. We have big losses. Compared to global high-yield bonds, Asian high-yield bonds are showing material losses resulting from a lot of uncertainty in China. Let's mention Evergrande, for example. All sorts of uncertainties related to policy action in China. While global bond markets are seeing let's say, more a negative year than a positive year, despite the fact that we have certain building blocks that are doing well in our investment-grade bond portfolio, the equity markets are doing fantastic. So globally diversified equity portfolios have seen double-digit performance, which is much higher than usual. Typically, long-term equity returns are in the range of 6 to 8%. This year, we're seeing clearly double-digit returns. Medium to small-size companies are doing really well. And in the US, small and mid-caps are probably shooting the light out at the moment, only followed by India, or better say, only led by India, because India is up even 33%. Europe is also doing well this year. We've seen many years where Europe underperformed, but this year that's not the case. Our quality active managers, the indices and European small mid-cap stocks are doing really well and are giving us a lot of joy. In general, we can say early in the year we had this discussion about investment styles, value, growth, quality, and so on. We can say that all styles are doing quite well. In the first quarter, we saw a bit of an outperformance of value, then a big recovery of quality and growth in the second quarter. And in the third quarter, we saw a more or less development on par, I would say. In general, active investments, our active investment building blocks, as well as index investments have done really well. We couldn't really tell which is better than the other. I mean, as you know, in the long run, we think that some of our active managers can beat their indices, their benchmark indices, for certain reasons. Others may not share that opinion. That's why we're talking about everything: indices, factor indices, and active management. Ultimately, it doesn't really matter. We want our clients to find something that works for them, not something that we think everybody needs to do. Whilst everything is seemingly great in equity land, China is a big disaster. It's the biggest disappointment of 2021. A lot of uncertainty. We were hoping actually that the 100th anniversary of the Chinese Communist Party would yield an equity bull market, but what we're now getting is a severe bear market. We peaked in February, and now many segments of Chinese equities are down a lot. Looking at technology stocks, some of them are down 50% and more, which is truly disappointing. And that has led to some market participants saying that China has become uninvestable. Clearly, it's disappointing, but we wouldn't go as far as to say China is uninvestable. China has been volatile in the past, but long-term investors in quality Chinese equities have done really well, have done as well as participants in US equity markets. So we wouldn't suggest to now throw in the towel. At the same time, you have to be careful how much money you allocate to Chinese equities. I would say clients of Das Family Office are not really impacted by the bear market in China. We tend to advocate globally diversified portfolios. So yes, we have some China exposure, but not too much, not to the degree that it would really disrupt performance. Then, maybe some takeaways. The current volatility, I do admit, is a bit unnerving, but it's not unusual for September-October periods. The situation tends to stabilize towards the end of the year. And I would say that maybe also this year this should be the case, because overall valuations of global equities are normal, if not cheap selectively. Where we see high valuations is with US technology stocks. But these companies tend to be of very high quality. They have very high margins, so maybe they deserve a premium. But if the market is looking for profit-taking overall, this could be an area where we will see less positive developments in the next coming quarters. Then China equities, I would not throw in the towel, I suppose. Situation looks really bad and disappointing, but valuations are really low. If you're looking at where some of the darlings, the tech darlings, were trading the end of last year, earlier this year, you can buy these same companies at very attractive levels. Obviously, we need to wait how the Beijing government is acting, but valuations are truly attractive. The same goes for Asian high yield bonds. The spreads are very wide, much wider than global high yield bonds, and once the dust settles, this may appear as really attractive entry levels. But don't forget that your target allocation to Asia should probably not exceed 20 to 30%. Make sure you have a globally diversified portfolio. Investors who are traditionally heavy in Chinese equities and who are probably not so happy about 2021, they may want to bear in mind that apart from Chinese equities, Indian equities have done really, really well in the long run, not only this year. This is not to suggest that you should now sell your cheap Chinese stocks and move into expensive Indian stocks. But maybe once, Chinese equities move in cycles. Once you have a more euphoric environment, maybe you take some profits in Chinese equities and move some of that money into India, and then hold a decent allocation in both markets for the long run. Then some of you may be tempted to take profits. I can understand. Many of you are sitting on nice profits. But tactical rebalancing, moving out of the market into term deposits, tends to not work. In the long run, the stocks of quality companies follow the earnings upward. So please, I know it may be tough for some of you, please hold your horses, please stay in the market, because moving into term deposits and investment grade bonds at current inflation rates is not really a good idea. Please don't do it. Overall, you should adjust your portfolio only if the life situation has changed. In a certain way, asset allocation is cash flow management. If your asset allocation needs have not changed, don't change your asset allocation. In general, I would also say, yes, there is a big discussion on inflation. Inflation is a topic that is quite concerning. But I can honestly tell you that portfolios that have a minimum of 20 to 30% equity allocation in combination with bonds could achieve 3 to 4% in the past several decades. And that is above the inflation rate for US dollar, which was a bit closer to 2%, let's say 1.8, 1.9%. So even a small equity allocation will help you to beat inflation. So if going forward inflation may move towards 3%, I think a simple adjustment of your equity allocation may do the trick. We don't even know if inflation will really move into a higher equilibrium. That's really not known to anyone at this stage. So don't worry overly about inflation. Then pure bond investors, okay, they may be most exposed to a rise in inflation because current interest rates are low. So please open your heart. I know many of you are not comfortable buying equities. What we're advocating is quality equities in a globally diversified way. Please open your heart, add maybe 20 to 30% of equities to your bond portfolios, also your high yield bond portfolios, and I think you will have a portfolio that looks more stable and will ultimately serve you better in the long run. Last not least, I think clients of Das Family Office are seeing good performance and are saving quite a lot of money because we're giving access to wholesale pricing, attractive custodian banks. So if you share my opinion, why don't you recommend us to your friends and families in your various networks? We'd be much appreciative. Now, we're coming to the end of the video. I hope you found it useful. We're linking the reflections document under the video. That leaves me to wish you all the best for the remaining months of this year. It's been quite exciting. It's been rewarding for most of you. So all the best and talk to you in January.